What if I told you that one of the richest men alive did not build his fortune by inventing an app, launching a crypto coin, flipping houses, or day trading from 6 monitors? He built it by reading, by waiting, by buying boring businesses, and by doing almost nothing for a very long time. This is the story of Warren Buffett, the man known as the Oracle of Omaha. But this is not just a story about a billionaire. It is a story about how wealth is really built, especially if you're watching this in your 50s or 60s and wondering what still works for someone like you. If you've lived through the dot-com crash, the 2008 financial crisis, the COVID market drop, or watched inflation eat into your savings, you already know the market can be brutal. Maybe you've asked yourself, did I miss my chance? Is it too late to grow what I have? The answer is no, it is not too late, and the path forward is simpler and harder than most people want to admit. Warren Buffett's biggest investment secret was not intelligence, luck, or perfect timing. It was patience. And the crazy part is, most people can copy the principle. They just cannot copy the discipline when nothing exciting is happening. Before we dive deeper, let us know in the comments where you're watching from. We'd love to hear from you. And don't forget to hit that subscribe button so you never miss any of our upcoming videos. Warren Buffett was born in Omaha, Nebraska in 1930. From the beginning, he was obsessed with money. Not in a flashy way, but in a how does this actually work way. As a kid, he sold chewing gum, Coca-Cola bottles, newspapers, and golf balls. He even bought pinball machines with a friend and placed them in barber shops. Most children were thinking about toys. Young Warren was thinking about cash flow and ownership. That is lesson number 1, and it still applies today. Buffett did not wait until he had a lot of money to start thinking like an investor. He started small. He learned how businesses make profit. And he learned that if a single dollar could create more dollars, then time could turn something small into something life-changing. When he was just 11 years old, Buffett bought his first stock, shares of Cities Service. The price dropped soon after he bought it. He got nervous and sold for a small profit. Then the stock kept rising, much higher. That moment taught him one of the most important lessons of his life. The real money is not made by constantly buying and selling. The real money is made by buying something valuable and holding it. Most beginners do the opposite. They buy because something is moving. They sell because they get nervous. They jump from stock to stock, idea to idea, trend to trend. Buffett learned early that the stock market is designed to transfer money from the impatient to the patient. Later, Buffett studied under Benjamin Graham, the father of value investing. Graham taught him a simple but powerful idea. Do not buy stocks like lottery tickets. Buy them like pieces of a real business. Imagine you were buying a small shop in your neighborhood. You would ask, how much money does it make? Does it have debt? Do customers come back? Is the price fair? But when most people buy stocks or funds, they often forget all of that. They just ask, is it going up right now? Buffett learned to ask a better question. What is this business actually worth? If the business was worth much more than the market price, he bought it. That was the foundation. Buy good assets for less than they're worth. Then wait. But Buffett was not perfect. One of the biggest turning points in his life started as a mistake. In the 1960s, he began buying shares of Berkshire Hathaway. At the time, it was a struggling textile business. Factories, fabric, a declining industry. Not exciting at all. Buffett bought it because it looked cheap on paper. Eventually, he took control in 1965. Later, he admitted that buying Berkshire as a textile company was one of his worst investments. Why? Because a bad business can stay bad for a very long time. Cheap does not always mean good. A low price is not enough if the underlying business has no future. That lesson changed everything. Over time, Buffett shifted his approach. Instead of only buying average businesses at bargain prices, he started buying great businesses at fair prices. And that shift, helped by his longtime partner Charlie Munger, changed the trajectory of his wealth. Munger pushed Buffett to focus on quality. Do not just buy something because it is cheap. Buy businesses with strong brands, loyal customers, pricing power, and long-term durability. That is why Buffett bought companies like See's Candies, Coca-Cola, Geico, American Express, and later Apple. These were not random trades. They were businesses with real advantages. What investors call an economic moat. Buffett was not trying to guess what would happen next week or next month. He was asking a completely different question. Will this company still matter 10, 20, or 30 years from now? That is a different game entirely. Most people play the short game. Buffett played the forever game. Now here is where Buffett's wealth machine becomes really interesting, and where it connects to regular investors. One of Berkshire Hathaway's biggest advantages came from insurance. Insurance companies collect premiums today and pay claims later. That money sitting in between is called float. Berkshire used that float as investment fuel. Millions of people pay insurance premiums. Berkshire holds that money and invests it carefully. As long as the insurance side is run conservatively, Buffett had access to large amounts of capital that could compound over decades. That is how Berkshire became more than a company. It became a compounding machine. You might be thinking, I don't own an insurance company. That is okay. The principle still applies to you. Every time you reinvest dividends instead of spending them, or add a little more money regularly to your IRA, 401k, or brokerage account, you are building your own version of float, money that can work for you while you sleep or while you enjoy retirement. This is why a massive amount of Buffett's wealth came later in life. Compounding looks boring in the beginning. You invest. Nothing crazy happens. You invest again. Still nothing crazy happens. But over time, the growth starts feeding on itself. Money earns money. Then that money earns more money. The snowball gets bigger. At first, it looks tiny. But if you keep pushing it long enough, it becomes almost unstoppable. Buffett once compared wealth building to rolling a snowball down a very long hill. The trick is simple. Start as early as you can, keep going, and find a very long hill. Most people fail because they stop pushing too soon, or they push in the wrong direction by chasing the latest hot trend. So what can we actually learn from Warren Buffett that applies to someone watching this right now? First, buy assets, not hype. Buffett is not chasing whatever is trending this week. He wants businesses or funds with real profits, real customers, and long-term value. For most people in their 50s and 60s, that often means low-cost broad market index funds, something Buffett himself has recommended for the average investor. Second, understand what you own. If you cannot explain in simple terms how a company or fund makes money and why it should still matter in 10 or 20 years, you probably should not own it. Simplicity is a strength, not a weakness. Third, think long-term. Buffett does not buy because something might go up tomorrow. He buys because he believes the business or fund can grow over many years. That means checking your statements less often, not more. Once a quarter is usually plenty. Fourth, avoid unnecessary mistakes. Buffett focuses on the risk that truly matters, permanently losing money. That is why having an emergency fund and paying off high-interest debt usually comes before aggressive investing. Fifth, be patient. This sounds simple, but it is the hardest one because patience feels like doing nothing. In investing, doing nothing, when you already own quality assets, can be a superpower. Now you might be thinking, okay, but I am not Warren Buffett. I do not have billions of dollars. True, but you can copy the mindset. You can spend less than you earn. You can invest consistently, even in smaller amounts. You can avoid emotional decisions when the market drops. You can give your money time to grow instead of constantly moving it around. Warren Buffett's story is not really about becoming a billionaire. It is about understanding that wealth is built through behavior, not excitement, not predictions, not trying to look smart. Just consistent, patient behavior over a long period of time. The average person wants fast money. Buffett got rich slowly. The average person wants constant action. Buffett waited. The average person wants secret opportunities. Buffett bought obvious, high-quality businesses and held them for decades. And that is the uncomfortable truth. Building real wealth is not complicated, but it is hard because it requires you to be consistent when nothing exciting is happening. Warren Buffett's life teaches us that the boring path can be the powerful path. Read more, spend less than you earn, invest wisely, avoid big mistakes, let time work, and most importantly, stop looking for the one magical investment that will change your life overnight. Because Buffett did not build his fortune by predicting the future. He built it by owning valuable things for a very long time. That is the real secret. Not speed, not hype, not luck, but patience. In a world addicted to quick wins, patience might be the biggest investing advantage you have right now. So here is the question I want you to carry with you. Are you building wealth like a trader chasing the next move, or like an owner building something that can last for the next decade and beyond? If this video helped you see things a little differently, give it a thumbs up, share it with someone who needs this message, and subscribe for more simple, honest money lessons made for real life in your 50s and 60s. Thank you for watching all the way to the end. I'll see you in the next one.